Hey guys, we're going to be talking about a normal front load. If you've been around the channel or seen any of our stuff, you know that we like to talk about front loads, and for people that have money that they're sitting on that they might not want to put every single year into the policy, but they want to kickstart it and get started with a life insurance policy. A front load design could be a great way to do that. One of the criticisms you could say or comments that we get is you're using a lot of big numbers. One of the reasons is it's common for people that do front loads. They're sitting on a lot of money. So that's what we show them. Thanks to Austin, we're doing what's called a normal front load. Going to walk that through. So without further ado, Austin, I'm going to hand over the microphone to you and have you talk about number one, why you like front load. Number two, why these numbers. And number three, just excited to learn how you've put this thing together.
Yeah. Well, thank you very much, Caleb. Appreciate how kind you are in handing me over control for this video. So I got this inspiration from a conversation I had a couple days ago with a client where she kind of almost sheepishly asked me like, what do people do, like normal sized front load? And like, I realized we didn't have any videos about that. We have like really big ones and we have carrier specific ones. So I was like, hey, in honor of her, let's just do like a quote unquote normal sized front load. And this is what you see. So I, gave our client a very great client name, example client here. This is just middle of the road in terms of the age, non-smoker status, middle of the road health status, and even kind of a middle of the road number status. Now, if you've seen our channel before, front loads is you're having this kind of bigger dump in the first year, and then you're kind of having a smaller dump in years 2 onwards. And so we generally recommend, we talk with many of our clients, is that at least 20% of year 1 in year 2 to kind of see the efficiency that you'll want to see going on. And so in this one, I did a little bit more than that just because it's a nice whole number. So 75,000, as you see right here, going in the first year, and then 25,000 going in every year after that. So this is with Guardian. Guardian is a great carrier to do front loads with. We can also do front loads at Lafayette Life, at Mass Mutual. We can even do it at One America. So there's other ones that we can do. And there's obviously specific reasons that if you came to us and that you kind of told us your specific situation, why we might go with one over another. But this is just the one that I chose to do for this one right now. Now, it's important to realize that when there's only really specific times that doing a front load, in my opinion, is the best strategy. I'd say for most of the time, for most people, just doing a max cash, the same amount every year, if you want long-term performance over a long period of time, is the best strategy for you. I'd say there are very specific instances when a front load makes sense. For people who need a lot of liquidity really fast, and really probably even I'd say within a calendar year of starting the policy, I think a front load is a really strong option. So a lot of real estate investors fall into this category, especially people who are either already in the real estate business, they're already kind of have a portfolio, and they want this rather than getting a HELOC on one of their houses or something, and they needed to deploy it immediately. This makes a lot of sense. If you are more so in kind of just like you want this life insurance policy and you just kind of want an opportunity fund because who knows what you might want to invest into, the same kind of urgency isn't really needed as what you see in this front load, because ultimately long term, a max cash policy is going to be more efficient. Caleb, is there any like other scenarios where you would think off the top of my head?
I think it comes down to the idea of opportunity cost. There's some people that value liquidity and access to money more than maybe a higher internal rate of return. And cool things, because when people come to us, we give them different scenarios and they get to choose and they get to see the pros and cons of different ways to design policies. What I love about front loads is a lot of times people see the benefit of insurance. They want insurance on their family, but they don't necessarily want to commit to what could be perceived as high premiums every single year. And so a front load allows them to get insurance on their family. They get a high liquidity access. And yes, does it underperform what they could have gotten? But that's almost unfair because they wouldn't have wanted a typical traditional max funded policy. And so it's one of those where you're totally right. When we dive in, sometimes people decide against a front load when they see like what it could look like, or even we're going to do another video on what's called a PDF strategy, which is a version of you having money and you front load it, but it funds over a period of time. There's advantages to that, but there's also advantages to getting it all in the policy. So I would say I liked your summary, and there are reasons why people choose to do it. I actually really like that concept of front load, because while I'm a big fan of insurance, the reason I use insurance is not because of the rate of return, it's because of the protection elements. And so I'm actually okay if it gets a smaller internal rate of return over time, knowing that I have access to more capital. For me personally, I'm like very much in love with front loads for that reason.
Yeah, and that's important for me to realize, because some people do like, and it's valid. If efficiency and rate of return is like, one of the most important things to them, well, then just purely on paper, the way that front loads work is that you're buying a lot of extra term in order to put in that big dump in year one. And so if you're not actually using that full amount of term to put in as much premium as you can year two onwards, it is going to be a little bit less efficient. But once again, efficiency is not the only important number. Is that the money that you're putting in here that you want to dump it in year one is providing you extra peace of mind and like some other like intangible benefits that are like kind of outside the confines of this illustration. That could be a really strong reason to go this way too. So there's good reasons to go here, good reasons why not to. And so this is just what it would look like for you if you got a normal size front load. Bring your eyes down here. So at Guardian, we're going to bring your eyes over here right now. Where does this $75,000 come from? So the base premium, or the minimum that must be funded in order to keep the policy active, is $3,400, which is really low. And that's why people they love front loads, is because they can get those base premiums super low for the total amount of insurance that they get to have.
And I just want to pipe in what that's also saying is we're able to put $75,000 in year one, but the base contract, meaning the minimum that you have to pay, is $3,412.90. Now, I'm sure there's term rider as well that needs to be included in that, but that's insane. Like every year after that, you can put up to $25,000. But the minimum is going to be the base plus a required term, which creates massive flexibility, which means you have flexibility ongoing with funding, but then you also have flexibility even if, God forbid, you couldn't fund in a year. You have so much cash value that you could easily pay the minimum. So I'll let I'm sorry if I killed the momentum there, but it's just I'm just amazed by how flexible these policies can be. Set up.
Just like you said, at Guardian, and once again, there's different things carrier to carrier. At Guardian, you actually pay the term out of pocket for the first 2 years, and then the policy's dividends actually take care of the term after that. And once again, that's just specific to Guardian. But you have $3,400 here in base, and for the first 2 years, you're going to pay this $800 in terms. You're at $4,200, and then at Guardian, they have this specific thing called a scheduled paid up edition, which means that it's paid up editions, but it's just scheduled, like you have to pay it as if it was required. So you're looking at pretty much $5,200 total that you have to pay in order to keep that high limit of being able to overfund if you want to in the future. That's pretty amazing, right? That's a really low base. That's really, really cool. Coming down here a little bit further, I'm going to even zoom in so that it's a little bit easier for everybody to see. So you have $75,000 going in year one. We live over here mostly in the non-guaranteed side, because the non-guaranteed side is assuming the dividends. We like to say the dividends are not guaranteed, but they are certainly assumed, especially considering Guardian's performance. Guardian's paid dividends every year since 1868. It's a pretty strong track record, and they probably will likely do that in the future. So as you see here, you put in $75,000 year one, and then you have the cash value over here and the death benefit. This is kind of the two numbers that we look at a lot kind of going forward for the rest of this video. So you put in $75,000 year one, and by the end of year one, you look at that net cash value over here, $69,000, just a hair over $69,000 in the cash value. And a percentage of that, somewhere between 90 to 95%, is available for you to borrow against day one. That's pretty amazing, right? And from day one, this is the strong thing with front loads, 1.3 million death benefit day one, instant coverage. That's super cool. It drops now. So in year two, you don't put in the full 75, you only put 25 in. So you've now put in a total of 100,000 here with this cumulative outlay column. By the end of year two, you have about 96,000 liquid cash dollars available, and then 1.35 million death benefit.
It hasn't broken even yet, but from an annual contribution limit, you've put $25,000 in, and your cash value has increased by more than 25,000. That's also a great sign of a great policy.
In year four, so it doesn't break even in year two, but it does in year four, which is wildly early, right? So you've put in, as you see, 150,000 into the policy by year four, and you have almost 152,000 net cash value. So it breaks even super early, a lot of liquid assets that you can use to invest in income producing activities. You're still having a super high death benefit that protects you and your family. There's a lot of people that this could be a really great policy for. And for a lot of people, 75,000 is not pie in the sky sort of number. Like that's like a number that they have on hand, maybe spread throughout a couple bank accounts. Maybe they liquidate a couple things or whatever, but like 75,000 is like not an unimaginable number here.
Hey guys, I just wanted to interrupt real quick. If you're watching this and have an index universal life policy, a whole life policy, have any type of insurance policy in general, and you're like, I want to know if I'm on the right track. I want to know if this is set up properly. We at BetterWealth want to help you. We want to give you a free policy analysis and show you, are you on the right track? Is there some things that you potentially could be doing better? And so we have a link down below that you will have access to. We would encourage you, if you have a policy and you want to see if you're on the right track, check that out. And if you're someone that's watching this and you're like, I want to talk to someone maybe setting up a policy for myself, or I have questions, we would love to serve you. You can also see a link to have a call with someone on our team. Back to the episode. I just want to point out that maybe the 25,000 every year doesn't feel like a normal, like that could feel high. And the minimum is only 4, essentially. Like, and it's actually less than that after year 2. So it's just like, that's just something to remember. There's a lot of people that have policies that are way more appropriate. It might be 5,000 or 10,000, but like almost all of it is going towards base comp. It's just one of those things to point out that, yeah, these numbers still might feel high, and it's not the end of the world if, year 3 or 4 comes along and you only put 15. You know what I'm saying? It's like, it's maybe not what we've designed, but it's still going to perform extremely well. And so that's important to always note, because sometimes when people look at these numbers, instead of the freedom that they should see with those numbers, they almost feel trapped, that they're like, oh, I have to pay in 25,000. It's like, no, you don't.
And that's one of the best things about front loads is the flexibility you have to go all the way down to that minimum and all the way up to that maximum. Because especially, and if you have a job where you're earning commissions, like you're in sales, and who knows what your pay is going to look like over the year, and you get a huge quarterly bonus or something, this is a great place to dump it into. I'm actually working with somebody right now that's kind of like what she's thinking about is like, where do I put my quarterly bonus, that sort of thing. So yeah, absolutely. Just to go on a little bit further. So you have year 10 coming up here, and year 10, you've put in 300,000. You have over 350,000 of cash available to borrow against, and 1.35 million of net death benefits still. It's just awesome. Year 15 rolls around. Then this example client right here has put in 425,000, 557,000 of cash value, 1.35 million of death benefit. And then we'll go on to year 20. So something interesting has happened here. As you see, there's the contributions have stopped in year 19, and it's just actually a static 500,000. So this one has turned on something called premium offset. He's not personally funding the policy anymore. It's just being self-funded, but the cash value continues to grow, even though he's not funding it. And the death benefit is also going to continue to grow. By the time he's ready to retire, he has this policy that he doesn't have to mess with anymore. The policy can be self-funded. He has this ever increasing death benefit over here, as you see. And also right next to it is this ever increasing cash value as well. A lot of really good things happening inside this policy. And for the right person, I think this could be a really strong fit.
Amazing. Yep. I don't know if I have anything else to add other than appreciate another example of what a front load policy could look like, but we're not going to use numbers like 100 or 200 or 500,000, even though we very much could. We're going to use $75,000 going in, $25,000 ongoing. Let me ask you this. What is the minimum number you think would make sense for a front load?
For a front load, I would wager like 20 to 25,000 for a front load would probably be as low as would make sense to go. I don't think I've actually had anybody ask me for less than that. I'd say that would probably be like the absolute minimum that it would make sense to.
I've personally seen and done front loads of like 40,000. I'm trying to think if we've gone lower than that. I'm with you, because if you go much lower than that, it may be beneficial to just not design it with the front load. The base can only go so low from a standpoint. So it's one of those things where it's always good to analyze. So if you have a policy that you want us to review, we will do that. We'll have a link down below. And if you want to talk to someone like Austin or someone on our amazing team around, does this strategy make sense? We'll also have a link where you can just connect with one of our coaches. And so we very much take education seriously. That's why we're doing these videos. That's what we do for our business. And so thank you in advance for watching this, commenting, subscribing. And if there's anything that we can do to best serve you, please click the links below. Austin, any final words for you?
No final words. You summed it up just perfectly fine. I had a lot of fun putting this together. If you have a normal size front load that you have an idea for, call me and let's put this in the sandbox. Let's figure this out, and then we'll put our heads together, and I'm sure we'll make something work.
I don't know, Austin. I don't know if people want to be referred as normal, but maybe if you identify as a normal person, raise your hand in the comments. I could be wrong.
If this is a normal amount of money, I want this much money.
Austin Williams, nice. The man of the normal people.
Yeah, normal guy. All right.
I love it.
Thanks so much.